After years of losing trying to figure out trading, thinking that some kind of magic strategy will actually make me profitable, is when I finally found the one candlestick pattern that actually changed my trading forever. And I'm not talking about some random pattern, I'm talking about pattern that has 80% win rate and has made me over $100,000 in payouts. In trading, when something is repeatable and proven to work, you can make a lot of money. So let's get into it. Okay, so here we are. So I'm not going to waste any more of your time. So let me actually show you what it is. So the thing that we are going to be learning today is going to be called SCM, and what that stands for is for structure, correction, and manipulation. So this is something that market is basically built of, and in today's video you will just understand why, because this is a core of the market and this happens all the time in the market. So let's start with step number one, which is going to be the structure. So let's go to structure. So the first thing you want to do when you come to the actual markets is you want to identify the structure. And how do we do that? Basically, when we come to the market, you can see that right here, for example, these two candlesticks, what we did, we just pushed to the upside. So what does that tell us? That market at the moment is going to the upside. So all this is just us basically finding these pushes to the upside or to the downside. So all we are looking for is a push to the upside, push to the downside, that basically gets repeated multiple times. And what that actually makes us know is that we are actually in some kind of bullish uptrend, because you can see we actually made a push to the upside, few times correction, and push to the upside. So that means that we are actually making structure to the upside. So all we do on the chart is we just spot where the market is actually pushing to, and that is actually where we are going to trade towards to. So that is it for the first step. So let's right now go to the second step. So the second step is going to be after we get those pushes, so after we get those structures like this, what we want to see is a correction. So really simple. When market creates some kind of push to the upside, let's say one like this, what it actually needs to do, it needs to rebalance, because if markets could just pump all day long, they would do it, but they can't, and they have to be kind of unpredictable. So after a huge pushes like this to the upside, what they have to do is they have to rebalance, so make a small move to the downside, so make a small opposite move that is actually going to kind of level out the buyers and the sellers. So since we have here loads of buyers, who is going to sell out of nowhere? Nobody. So they have to kind of stop buying, bring down the market, so let the sellers take control a bit, and then when they come here, when there is again loads of sellers, they are going to try to push the market to the downside. Now we can have buyers step in again and actually push the market to the upside again. So that's how we actually make a proper trend in the market. So we have to have structures and we have to have corrections, and that's basically it. Really simple. Now, what is correction really important for? Since we have, let's say, structure right here, so this is our structure number one. So I'm going to create this one like this. So this represents this leg right here. So this is structure for us right here. What is the next step? We have then a correction. So this one right here is a correction move from right here to down here, and you can see right here we made these lows right now right here. So in the correction that looks something like this, we are going to have a certain low where buyers are going to start buying, and we are probably going to get reaction to the upside, maybe multiple times. And what is going to happen actually is, if market was so predictable, of course everybody will just know that, all right, we made this correction, now what do? We just start buying to the upside and we get into long positions. But if market was like that, everybody would make money. And the point with market is retail traders, 95% of them, even more I would say, actually lose money. So market cannot be this predictable, because they actually think that right now, all right, we made a kind of retest, we came down again, still retested this and just trying to go to the upside. So what I expect to happen is for us to actually just continue going to the upside. But what is actually going to happen is going to be right here on the step number 3. So after we get structure right here, we get a correction. What is going to happen before we actually make another structure to the upside? What is going to happen is called manipulation. So that is going to be step 3. We are going to wait for the manipulation of the low of the correction. So what is the whole logic behind this? So let me explain you this. So we made structure to the upside, correction, and then we want to potentially start going to the upside again, making another structure. So this right here is a correction phase. So this small leg right here is a correctional phase, and what happens in this correction phase is we start accumulating a lot of buyers into the market when we actually start giving some kind of reaction to the upside, because all the people see this rebalance and they see us starting to go to the upside again. They are like, all right, this is a move that is going to bring us all the way to the upside to some kind of, important level. What actually happens is when we actually get this rebalance, we start going to the upside. This move right here is going to accumulate a lot of buyers into the market. So a lot of buyers are going to step into the market. They're going to enter right here. Where are they going to put their stop losses? On the low of the correction leg. So that is the most important key part for us. They are going to put a stop loss on the low of the correction leg, and that is going to be thousands and thousands and thousands of traders who are going to put their stop loss right here. So what that means for market makers, for banks, institutions, for people who actually move the market, that is going to mean that if they actually bring down the market one more time like this, they are going to actually sweep all the stop losses from right here. So this is going to happen, and that means that they're going to stop 95% of retail traders out of the market. And if they do that, they're going to even be able to get in with more money in the market. So it's a lot smarter for them to do this manipulation leg. And after that manipulation leg, what happens is, since they just collected all the money right here, they continue the most normal way. So they just continue making structure, correction, and then another manipulation and structure. So market is going to always repeat this. So you can see right here we made structure to the upside, correction, and here we just induced a lot of buyers into the market because they expected us to actually just continue going to the upside. But what actually happened is market wicked to the downside, came back to the upside. Right here it gave us entry that I'm going to show you later how it looks, and what happened is it pumped to the upside. So really simple. And the most important part is going to be the entry time frame. It is going to be done on the 5-minute time frame, and we are going to look for this specific pattern. So after we actually get a liquidity sweep in the market, what we are going to do after is we are going to spot the last imbalance in the market. So while we are going towards the liquidity sweep, towards the downside, we want to leave a fair value gap in the market on the 5-minute time frame. So what a fair value gap is, we have 1, 2, and 3 candlesticks, and you can see right here from the first candlestick's wick low to the third candlestick's wick high, there is an open space. So that right here is an imbalance or a fair value gap. And the same thing goes for when the candlesticks are going to the upside. It's going to be the first wick's high to the third wick's low, and that's basically it. It's going to be still the same thing except while going to the upside. So our entry is going to be based off us leaving a fair value gap or an imbalance, sweeping a correction low. So it's going to be called a liquidity sweep, which is just a sweep of the correction low in the manipulation phase. What that happens is, how do we actually enter the market, is when we actually close above the imbalance. So why do we do that? Because when we close above the imbalance, we know that market disrespected something that should have pushed it to the downside. So usually these fair value gaps are making market react and respect them. And if we manage to inverse them or disrespect them like this, what is really likely to happen, about 80% of the times, market is going to start going to the upside and get us a winning position. So that is the whole logic of it, and why is this strategy even better, because of this entry model. And the final part is, how do we actually put a stop loss, is when we execute a trade, there becomes a structure phase. So we start going to the upside, we put our stop loss on the candles low, and we put our TP on the some high to the upside, where we basically target some kind of liquidity. So if you want to put it, let's say one more time again, so the first thing is we are going to make structure. You can see here we made correction, manipulation, but we are going to go to this one right here. It's more nicer. So we made structure to the upside. After that, we made a correction, so this part right here, and after correction we made a manipulation where we swept the bottom of the correction phase, and then after that we continued with the structure, and of course it is going to repeat itself in the future. We are going to get another manipulation, another structure, and it's just repeating on and on and on like that. So let's right now actually go to the chart and to actual live examples. Okay, so I'm just going to explain this one more time before we actually get into the live chart. So the first thing is, of course, right now I'm going to show you the bullish example of us making structure to the upside and then getting a setup. So let's say we are making some kind of structure to the upside, and right now we made some kind of correction. Now if the market retested this level right here and wanted to bounce back off to the upside, what would happen? A lot, and I mean a lot, of people would just make money out of nowhere. So there would be nobody to actually manipulate, to actually make this money. So it's quite impossible that this happens all the time. This can maybe happen sometimes in the market, but it's gonna happen really rarely. So let's right now see this example where we basically make structure to the upside. We retest a really nice level. We maybe retest it few times like this. And what happens is, instead of us just going to the upside and creating another structure, we do this manipulation before it, and then after that we get our entry model right here and we start pumping to the upside. So this is going to be our perfect scenario for the entry in the market. Or if we are going to the downside like this, we made huge structure, correction, and we right here induced a lot of sellers in the market. What we then do is we sweep all of them out. Right here we get our entry confirmation and we target some kind of lows or lows down here. So that's really all of it. So right now let me actually show you some kind of examples on the chart. Okay, so here am I at the 1 hour time frame. So 1 hour time frame, we are going to look for the structure, for the manipulation, for everything. Right now the important thing is for us to actually understand where each phase is. So we have the first phase right here, which is going to be color green, and it is going to be our structure phase. Right now we need to go on to the next one, which is going to be a correction phase. So this one right here is going to be the correction phase. So you can see after a big push to the upside, we started slowly going to the downside. So that's really the point of the correction, for us to actually make a retrace. Now what is correction really important for? Of course, for getting manipulated. So what we have to do is we have to mark out the low, because we are later going to wait for it to actually get swept. Right now you can see that market is, accumulating buyers into the market, so it's making a little bit of a push. So all the people start, doing this and start putting their stop losses below the low, and there's going to be hundreds of traders like this that are actually going to do that. So right now, when you know that, let's actually wait for the manipulation to happen in the market. So looks like we are going to the downside. We can even scale down to the entry time frame, which is going to be the 5-minute time frame, and actually wait for the manipulation. So let's see, when is the manipulation going to happen. So there it is, an actual manipulation, and you can see how it happened exactly on the market open. So you can see 9:35, this manipulation happened exactly when the big boys rolled into the market. So right now what we do, we mark out the last imbalance in the market like this. All we wait for is the disrespect of this imbalance, and let's see if that will happen. So right here we just wicked inside of it, so this part is weak. We do not want to see that. We want to see a body close above. So let's see what happens. Okay, so there it is. So this is an actual entry where we can enter into the market, and of course when we enter, we put our stop loss below the candle, as I told you. And what do? We target some liquidity to the upside like this high right here, because that is the final high. So right now, if I fast forward the market, let's actually see what happens. And you can see our take profit got smashed in like 7-8 minutes, and that is so perfect. So one more thing I want to add before I show you the whole picture of this is 2.76 risk to reward. This is about $2,700 on a simple $100,000 funded account, and you can have so many of those. So let me show you right now this. If I go back to 1 hour time frame and I remove this out of the chart, you can right now see how we manipulated this low. So this right here is actually our manipulation phase right here, so you can see it, and then we start to continue with an actual, you know, structure phase to the upside that is potentially just going to pump to the upside, and you can see it going to the upside. And then, you know, the same thing happens. We start doing the correction leg, and then we manipulate that low, and that is just always going to repeat itself in the market. Alright, so I hope you liked the video. One thing before you actually leave the video, if you want, subscribe and like this video. So subscribe on the channel so you never miss another video like this one. Also, if you want to claim something for completely free, I'm gonna give it to you. It's going to be right down there in the description. It's gonna be the playbook of this actual model, so completely free. Go down there, click on it and just claim it. Also, one more thing, right now at the moment I'm actually running a one-on-one mentorship that of course has limited spots. So if you are interested in it, make sure to go down there in the description and actually book a call where we will also see if you are a right fit for the mentorship. So with all of that being said, I just hope you enjoyed the video and liked it, and I'm going to see you in the next one. Peace.